Why property insurance is a big problem in multifamily. Hey everyone, welcome to this week's video. Today we're going to be talking about a topic which admittedly isn't the most interesting topic, but it is very important in our industry right now and across the whole property industry, not just multifamily, and that is insurance. Now, insurance has always kind of been an afterthought in investing in real estate and multifamily real estate. Oftentimes, you just get an insurance policy right before you're supposed to close. I know me personally, I'd always kind of leave it to the last minute. And that's because property insurance used to never be a huge deal. It was such a small expense in relation to the property itself. It's not something that's going to move the needle in any significant way. You usually don't have any kind of inside track to get a really deeply discounted insurance policy. They're more or less going to be the same. But in recent years, especially in the past couple of years, we've seen big spikes in property insurance and liability insurance as well across the country, not just in disaster-prone states like California and Florida, which often gets talked about in the news, but everywhere across the country, the insurance market has become particularly tough. So why is that? Can we kind of uncover, dig a little deeper to find out what actually makes the insurance industry tick and kind of understand a bit more about where these premiums could go? Is something going to change, or is it going to keep getting worse and worse? So the first thing to know is that the total loss risk seems higher. Now, these insurance companies are a bunch of actuaries who are crunching numbers and data and algorithms, and they're coming up with risks. What is the risk that there's going to be complete loss on a property? So if you have a multifamily property and you're in Florida or California, what are the chances that, a hurricane is going to come and wipe it out? Or if you're in California, maybe a wildfire, or somewhere else in the country, it could just be a localized fire or something happening, complete flooding, that's gonna be cause total loss. So total loss means the property is destroyed, has to be completely demolished and rebuilt from scratch. That perception has seemed a lot higher in recent years, and maybe that's because of a number of hurricanes that have hit. We've obviously had the big wildfires in LA County, just recently. So it seems as though these events that are happening more and more often also getting more intense, and whether that's actually true or not, and whether that can actually predict the future, we don't know. But the way that the insurers seem to be crunching their numbers, they are building this increased risk into future models, and that's what's causing these higher premiums. The next thing is cost to replace is much higher. So this goes hand in hand with the total loss risk, but the cost to replace is much higher. So you might have a 100-year-old building that you picked up for $3 million, but the cost to actually build that building new, maybe $10 million. And so the actual payment that the insurer will have to make if it is destroyed or has to be demolished is much higher. And especially with construction costs rising these days, it means they have to insure them for much more. So what a few years ago might have been $7 or $8 million to build now costs $10 million, and next year might cost 11 or 11.5 million to replace. So they have to factor this into their calculations, and that means they're going to come up with a much higher number of not just amount of potential properties that could be lost, but the cost to replace them is going to be higher, and they have to recoup that money somehow. And how do they recoup it? they increase the premiums. Now, as we said at the start, premiums have continued to rise, and it's not just a case of premiums being a lot higher, but in some cases, there just isn't an insurance market at all. I've seen it with older properties, especially those that are 70, 80, 100 years old. Even no insurer wants to touch them. There's just so many things that can go wrong with them. And that's a huge problem when there's no insurer there. Now we open up a whole new can of worms. We might have banks, lenders require that there's property insurance for the property. So if there's no insurer, what happens? What happens then? It's definitely something that we haven't had to deal with in the past. So what else do we have? We have fraudulent claims. Now, fraudulent claims is unfortunately a part of the industry. It's been growing even more, especially as we've had hurricanes come through, not just Florida, but hitting Georgia, the Carolinas, all up and down the East Coast. And what you do have is that you do have some damage happening, but a lot of it could be pre-existing damage or damage that really wasn't caused by the hurricanes at all, and yet people are making these claims. And it is a battle. There have been some very legitimate claims that insurers have denied for one reason or another, and that's definitely not right. But there's definitely a lot of fraudulent claims as well, and these just compound the misery when it comes to actual premiums and the insurance market out there. Every time there's a fraudulent claim, the insurer has to send an adjuster over. They assess it. They may have to go to court to fight against these fraudulent claims. There's a lot of work and people involved. So every time a fraudulent claim is made to an insurance company, someone's got to pay for it. And where that's actually paid for is through increasing premiums to those customers who have maybe done nothing wrong, have not made any claims, have not bothered the insurance, haven't had anything happen to their property. So these costs do get passed on. So that just further compounds the premiums in the market. And the last one I have here is misaligned interests. So what I mean by this, I kind of touched on it before, is that lenders require that properties, especially multifamily properties, be insured for replacement costs. So again, you might have bought the property for $3 million, but if it costs $10 million to build new, the lender, the bank, is going to want to see insurance for replacement cost on there. Now, obviously, this isn't great because if you need to insure $10 million worth of property, that's going to be a significantly higher premium than if you were just insuring $3 million worth of property. And especially with the market we're in with insurance, and if there's only one insurer out there willing to insure the property, then you're kind of at the mercy of whatever price they set. And this is where we've seen some really crazy numbers. When there's only a limited market, when there's only one player in the market setting prices, they can effectively set it wherever they want. So down here in Florida, I've actually seen homeowners who have paid off their loans. They don't have a loan on their property. They've actually decided to self-insure because the insurance market is that bad. They're saying, hey, rather than me pay $40,000 a year for home insurance, I'd rather just risk it and pocket the $40,000 and hope that a hurricane doesn't come and wipe out my place. But back to the misaligned interests, you have multiple parties here with different interests. You've got the bank who just wants to make sure that their money is their investment is secured in case of total loss. You have an investor who is trying to pay as least as possible in insurance premiums. Remember, the income directly relates to the value of the property. So if insurance rates are going up, not only do they have less cash flow every month, but the actual value of the building will be hurt when they go to sell it. So they need to keep insurance as light as possible, and they might not necessarily want full replacement costs, even though that's what the bank wants. And then you have the actual insurer themselves, and now they're trying to manage premiums and hope that they don't have a massive loss event like a hurricane, like tornadoes, like wildfires, any of the other natural disasters out there. And so they're also fighting a lot of headwinds. And so you've got a lot of different interests here, and they're not necessarily aligned. And that's causing big problems in multifamily. What we'll probably see in the future is some sort of government intervention if it gets really bad, and we're already starting to see some quasi-government intervention, but it could get more drastic the more people can't afford their insurance premiums and the less market there is out there. I spoke to a multifamily insurer down in the south over here, and he was saying that the insurance market is actually improving, which is positive news. However, something as a big hurricane that could come through in June or July could completely wipe out those gains and even put us in a worse position than we were insurance-wise. And this isn't just for hurricane or wildfire prone areas. This is for the whole country. These are big companies that are insuring buildings, and they spread the risk among their whole pool of premium payers. So it's a very actually complex and interesting market. It's important to understand how it works because property insurance definitely is starting to play a big role in investing, much bigger than it was in the past. So thanks for listening, and we'll see you next time.